Hold on to your seats as we dive into the fast-paced world of the economic boom. Buckle up, it's going to be a thrilling ride. The recent positive economic data has sent the stock market into a bullish frenzy. The third quarter GDP growth rate exceeded expectations, marking the strongest growth rate in 3 years. This surge in numbers isn't just a flash in the pan, it's a sign of potential sustained growth. On top of that, we've seen a significant increase in productivity. Now, this isn't just good news for businesses. This could lead to wage growth, putting more money in the pockets of everyday folks. And what's driving this productivity spike? It's all about the rebound of inventories and the recovery of supply chains after the pandemic. It's like the world's economy has been kick-started back into gear. As we've seen, the economic boom has set the stage for a whirlwind of activity. But what lies beneath the surface? The service economy, a key player in our economic narrative, is showing signs of imbalance. Let's unravel this complex issue. The pandemic has triggered an extreme fluctuation in supply and demand within the service sector. This imbalance is not only disrupting the economy, but also reshaping how services are delivered. Let's dig a bit deeper. The service sector, the largest part of our economy, has been hit with a double whammy. On one hand, we've seen a surge in demand for certain services such as digital solutions and home delivery. On the other hand, industries like hospitality and tourism have experienced a significant drop in demand, leading to job losses and business closures. Now, why is this important? Well, these fluctuations are causing economic uncertainty and volatility, which can impact everything from job security to investment decisions. It's like a ripple effect that touches every corner of our economy. Now let's look at what the experts are saying. According to the Bloomberg economist consensus, we're likely going to see weak growth, but no recession. However, Campbell Harvey, a well-respected economist, believes that the Federal Reserve's anticipated interest rate hikes may trigger a mild recession in 2024. It's clear that we're in a period of economic flux, with the service economy at the heart of this transformation. While some sectors are booming, others are struggling to adapt. This imbalance in the service economy is a crucial piece of the puzzle as we navigate the post-pandemic economic landscape. While the service economy grapples with imbalance, individuals are facing their own set of challenges. Rising home prices, high mortgage rates, inflation, these are but a few challenges people are facing amidst this economic boom. Despite the strong economic growth, there are several hurdles that many are grappling with. The cost of living is skyrocketing, and it's not just about the price tag of your groceries. Home prices have been on an upward trajectory, making the dream of homeownership harder to grasp for many. Coupled with high mortgage rates, even those who can afford a down payment are finding it tough to keep up with the monthly costs. But it's not just about housing. Inflation is rearing its head, causing the price of goods and services to increase. This means that your hard-earned money doesn't stretch as far as it once did. Every trip to the supermarket, every gallon of gas, every utility bill becomes a little harder to swallow. And then there's the looming shadow of a potential recession. The bond market, which has an enviable track record of predicting recessions since 1953, is forecasting a 98% chance of a downturn starting by October 2024. That's just around the corner in economic terms. The government's stimulus measures have certainly played their part in this complex equation. They've resulted in a significant increase in asset values. But the speed at which the excess money has been spent was underestimated by economists. This has fueled inflation and asset bubbles, contributing to the economic challenges we're seeing today. With all these challenges and predictions, the economic landscape is indeed a complex one. A mild recession is on the horizon, but fear not. Let's wrap up with some key takeaways. The Bloomberg economist consensus and Campbell Harvey suggest that the Federal Reserve's anticipated interest rate hikes may trigger a mild recession by 2024. However, it's important to note that financial stress indexes are currently below average. This indicates that the economy is more robust than some fear, despite the potential downturn. The bond market, a reliable recession forecaster since 1953, also predicts a 98% chance of a recession starting by October 2024. Now let's summarize the main points we've discussed. The recent economic boom, marked by a 4.9% GDP growth rate, is due in part to the rebound of inventories and recovery of supply chains post-pandemic. However, this boom has led to imbalances in the service economy and challenges such as rising home prices, high mortgage rates, and inflation. While a mild recession is expected, understanding these complexities helps us better navigate the economic landscape. While the economic boom brings both opportunities and challenges, understanding the situation helps us navigate these turbulent waters. Remember to subscribe for more insightful content.